Today is April 17, 10:43 a.m. We saw some unusual options on Netflix and wanted everybody to know and also show you what we did on a trade because it's not the same ones we saw. It's a slightly different trade. And so we'll show you how we use these unusual options. And keep in mind, earnings is coming up. So this is a earnings bet. This is April 18 after hours is the earnings. That's tomorrow afternoon. And so without further ado, let's take a quick look at these unusual options. So you'll see here the 382s, the strike price here, all these calls are being done this morning. You see one here, 1,000, and all of these. These are all in the just very recently. And when we look at the options chain for April 21, which is the closest options expiration, so that's over earnings period, you'll see all these strike prices on the volume here. If you keep looking down, you'll see this is the one that has the largest amount, 8,000 of them. Okay, so they had bought this 382, and so we can analyze this, and you'll see here that by expiration, as long as it's above 383, it is profitable. And so could this happen? Let's see, 382 for this year. Netflix was at 379, so it would have to make a new high for this year, since this is the resistance for this year. So let's look back a little further. Maybe we'll switch to the weekly charts, and you'll see here Netflix at one point in 2021 was at 700. So could it start making that recovery now? So that's a question that we will find out as earnings starts to give us more information when it's reported. So keep in mind, Netflix is at 332. It was at 1.700, so it still hasn't recovered from its 50% drop. It's a crash, and so perhaps this is a recovery in the progress of recovering. So our trade with this, since there is some uncertainty with earnings, and we wanted to also take advantage of it with the high volatility coming into earnings, because it's actually at 100 volatility here. We, instead of buying it like the unusual options, we sold it. So we sold it, and you'll see our position here. And so what that does is allows us to reduce our theta decay. So we bought the May 19. We bought the this strike on the 370s here. So we are buying this one. This volatility is 49. It's half of the 100%. So we like that, to buy at low volatility and sell at high volatility to take advantage of that. So what does this look like? This is going for 551 right now. You'll see here it's also bullish, so it does gain as the price at 332. If it goes up, it does become profitable because it is also above the zero profit loss on the y-axis. So this trade, the theta decay is positive actually, so that's why we like this trade. It's a 47 theta on this, so it's a very positive, very nice. If you were to just straight out buy the calls like what they did here, you'll see here the theta decay is negative 73. So we didn't particularly like that decay at this moment in time with the earnings uncertainty. This way, if the earnings surprise to the downside, we do have some risk reduction already because we sold that call and reduced our risk, and so that's why we like this trade. And so it's something to keep in mind. And yeah, so if we look at this earnings coming up on the dailies, so possibly we are expecting a breakout. And if we look at actually what happened in the last earnings, that it was done on January, you'll see here that it actually did come up and rallied about 8% up. You'll see there. So quite a rally after earnings there. So possibly a rally here as well. If it was just 8%, then it would hit about 360. If it was about the same rally, right? And so if it was around 360 for our trade here, at 360, we would be profitable. You'll see here, this profit is right here. It's above the zero line. Whereas if this, these 382 calls, 360 at that date, the profit may not be there. It will depend on we also have to keep in mind that the volatility will actually decrease. You have to adjust this volatility of 100. It's going to change after earnings. So for example, if once the volatility drops, so for example, let's say it drops 50% to where this is, you could see here a 50% drop in this really hurts the trade here. You'll see here at 160, if it hit 160, it would be a loss. It has to hit, I guess, at that expiration, it has to be above 370 for that to be profitable. And the profits aren't even that high. So keep in mind that this volatility is going to contract after earnings. So if you buy a call, like a call without selling anything, you have to keep in mind of this volatility contraction after earnings. Okay, it's a volatility crush. That's what it's called. So, yeah. So if there was any value from this video, please give us a like, and we can keep making these videos. So you can learn more on how we're trading these options before earnings, how we make these decisions, and subscribe and hit the bell icon, and you'll be notified immediately whenever we see these unusual options, because these options were also just done just a few minutes ago. All right, take care, everybody. Good luck.